You're scrolling through Zillow late at night, not because you're about to buy a house, but because you're quietly wondering, there has to be something reasonable out there. And then you see it, $200,000. That number makes you pause for a second. It sounds all manageable, almost like something that's still within reach. So you click, the first photo looks fine. The second one starts to show the age. By the third, you're staring at a kitchen with worn cabinets, scratched countertops, and that soft yellow lighting straight out of the early 2000s. Nothing is exactly wrong, but nothing makes you think, wow, this is a great opportunity. And yet the listing description is confident. Perfect starter home. You look back at the price, $200,000, and that's when the math starts running in your head. Not bank math, life math. Wait, if this is considered a starter home, then who can actually afford it? Here's the spoiler most people don't want to hear. If a $200,000 house still feels uncomfortable to you, that doesn't mean you're behind. It doesn't mean you failed at adulthood. It means the math has changed. My name is Nick, and today we're going to do something that makes a lot of people in the housing industry uncomfortable. We're going to calculate who can actually afford a $200,000 home in 2026. Not who a bank is willing to approve, not who a mortgage broker says is qualified, but who can buy that house, live in it, and still sleep at night without turning their life into a long-term financial stress test. Because there's a massive difference between being approved for a mortgage and being able to afford the life that comes with it. There's a massive misunderstanding that almost everyone walks into. The bank says you're qualified. The real estate agent says it's well within reach. Your friends say, come on, it's only $200,000. But qualified does not mean affordable. Affordable means you can make the payment. It means you can fix the house when something breaks. It means you can still save money. And it means you're not lying awake at 2 a.m. doing mental math about whether new tires have to wait another month. If every decision in your life starts revolving around one question, can we still cover the mortgage this month? Then you didn't buy a home. You bought a constraint. Because owning a house isn't just about signing paperwork. It's about whether your life still has room to breathe after you move in. And that distinction is where most people get trapped. In 2026, across a lot of US markets, $200,000 doesn't buy you a dream home. It buys you an older house, usually farther from city centers, often with deferred maintenance, and frequently in areas where job opportunities aren't exactly abundant. This isn't luxury housing, it's basic housing. And here's the part that actually matters. $200,000 has quietly become the floor for a huge number of buyers, not the bargain. So the real question isn't, can you find a house for $200,000? The real question is, what level of income can actually support that price, without turning everyday life into a constant financial balancing act? Because price alone doesn't decide affordability. Income does. Let's assume you're buying a $200,000 home. First, the down payment. If you put down 10%, that's $20,000 in cash. On paper, that sounds reasonable. Until you remember that most Americans don't even have $10,000 in savings. But let's be generous and assume you somehow make it work. Now the loan. After the down payment, you're borrowing $180,000. At projected 2026 interest rates, let's say 6 to 6.5%. Depending on credit, your monthly payment for principal and interest lands somewhere between $1,150 and $1,250 per month. And that's where a lot of people stop calculating. But that number doesn't represent the cost of living in the house. It represents the cost of borrowing the money. Now let's add the expenses people love to forget. Property taxes. Depending on where you live, you're looking at roughly $200 to $300 per month. Homeowners insurance. Rates have climbed steadily and you're realistically paying $120 to $180 per month. Maintenance. The standard rule is to budget 1% of the home's value per year. On a $200,000 house, that's about $2,000 annually or $170 per month. And if you didn't put down 20%, there's PMI, private mortgage insurance, another $100 to $150 per month paid to protect the bank, not you. So when you add it all up, mortgage payment, taxes, insurance, maintenance, PMI, your total monthly housing cost lands between $1,700 and $1,900, and that's assuming everything goes right. No roof issues, no furnace failure, no surprise repairs showing up at the worst possible time. Now let's flip the math around. Under healthy financial guidelines, housing costs should stay under 28 to 30% of your gross income. If your monthly housing cost is around $1,800, that means you need to be earning roughly $70,000 to $75,000 per year to afford that home comfortably. If we use the more generous standards banks often apply, allowing housing to take up 40 to 43% of your income, the minimum drops, but not by much. You're still looking at about $55,000 to $60,000 per year, and that's with very little margin for error. And here's the punchline. A $200,000 home in 2026 is only truly affordable for households earning around $65,000 to $75,000 per year or more, assuming they don't have significant other debt. That's not pessimism, that's the math fully exposed. Let's call them the Miller family. Their household income is $68,000 a year. That sounds normal. Not struggling, not wealthy. After taxes, they bring home about $4,200 a month. Now let's subtract the basics. Housing costs $1,800. 2 older cars insurance and gas $700. Health insurance premiums $350. Groceries for a family trying to eat reasonably well $600. Utilities, electricity, water, internet, phones $350. That leaves them with about $400. $400 for everything else. Car repairs, clothes, medical copays, something fun once in a while, and if possible savings. Every time an unexpected expense shows up, the credit card starts getting involved. They're not taking luxury vacations. They're not buying expensive toys. They're not living recklessly. They're just living inside a house that's technically considered appropriate for their income. And that's the part most people miss. On paper, this works. In real life, it feels like constantly holding your breath, hoping nothing breaks, nothing changes, and nothing unexpected shows up. So who can actually afford a $200,000 home in 2026? Not the person who only looks at how much the bank is willing to lend. Not the person who tells themselves it's cheaper than the market, so it must be fine. The people who can truly afford it are the ones who have income that comfortably supports the payment, a financial buffer for repairs and surprises, and enough margin that owning the house doesn't consume their peace of mind. There's no prize for becoming house poor, no trophy for stressing every month inside a place you technically own. A home is only valuable if it improves your life, not if it absorbs it. And sometimes the smartest decision isn't buying the house that's barely within reach. It's recognizing that right now that house doesn't actually fit your life. That's not failure. That's clarity. Because the real win isn't ownership at any cost. The real win is stability, flexibility, and being able to sleep at night without a mortgage payment sitting in the back of your mind. That isn't pessimism. That's just math finally taken seriously.